The warning signs are flashing, volatility's rising, and the market is slipping. If you're within 5 years of retirement and you haven't protected yourself yet, now is the time to do it. I don't know if a full-blown crash is coming, but history tells us it's always a matter of when, not if. And if you're not prepared, your retirement plans could be wrecked. Today, we'll talk through what this means, how it can affect you, and what you can do to protect yourself and your retirement. Let's start with the issue. The market has skyrocketed since the financial crisis ended way back in 2009. But here's the problem. When something climbs this high, this fast, history tells us it doesn't last forever. If you're 55 years old right now, in 2009, you were 39, your life was likely very different, and you probably had substantially less money at risk in the market. So what was then a great buying opportunity for you at that time to invest in a market so low now has the potential to wreck your retirement. Since that March 2009 low, the S&P 500 has gone up around 850%. That's a massive amount of gains. In that time, we had the COVID crash. That was pretty quick. It was a nasty drop, but we fully recovered within a few months. And then we had 2022, which was a bear market that took basically all of 2023 to recover back. But both of those, historically speaking, were fairly mild market downturns. The issue that happens as a result of that, 16 years of a very strong market, is that people forget what is possible on the downside of the market. They make assumptions that it'll always come back and it'll do that quickly. That's not always the case. I actually recorded a video about this that hasn't gone up yet because I wanted to push this one out as quickly as possible because of what's going on in the market. There have been times in markets where it's taken 10 plus years to recover from losses without taking a single withdrawal. Here's how that can wreck your retirement. Let's say that you're sitting out there like a lot of folks I talk to. You're your mid-50s to your mid-60s. You've been investing for years. You likely have two piles of money. One you can touch today. That's your cash. It's there for emergencies. And one that you put away for the future, your investment portfolio. But if you don't have a middle ground, a market downturn can devastate you at the worst possible time. I understand why you probably have money like this. And it's not even a bad plan while you're working. You have cash around for emergencies, and you have investments for someday in the future when you aren't working anymore. The issue is this: you actually need to modify your strategy into a retirement-based strategy before you retire. That's because things like a major market downturn can affect your ability to retire or the quality of your retirement if they happen too close to your retirement date and the market doesn't just recover quickly. Let me give you an example to show you what I'm talking about. I'm not even going to use 2008 because I honestly hope and pray that we don't ever go through another one of those in my lifetime. But let's look at the dot-com crash. 2000 to 2002, the market was down 3 straight years after the incredible run it went on in the late 90s. I'll give you an example of what this might have meant for someone close to retirement. Let's say that you were planning to retire in mid-2000, and let's say you had $1 million. And 70% of it was in the market, and we're going to use the S&P 500 here as our proxy for the market. And then the rest of the money, 30% of it, was just sitting in cash. And then the bubble burst. And in March of 2000, things started sliding. So you held off on retirement because your accounts were dropping pretty quickly. You decide, I'm not going to retire until my account gets back to $1 million. Here's the problem. That was in early 2000. By September of 2002, 2.5 years later, the market finally hit its bottom. At that point, your $1 million had lost more than $300,000, and that's assuming that a full 30% of your money was sitting in cash. You didn't actually recover back to the $1 million until mid-2007. Now, if you were planning to retire in 2000 and you ended up not retiring until 2007 because you hadn't even gotten back to where you were, how did that change your life? How did the stock market rob you of some of the best years of your retirement? If you were 60 years old in 2000 and you planned to retire then, but instead you had to wait until you were 67 because your portfolio tanked, what does that mean for your retirement? That's 7 years of vacations not taken, 7 years of working instead of enjoying the family and the grandkids, 7 years of life that you can't get back. That's what's at stake when I talk about assessing the risk in your portfolio. Now, this is not all doom and gloom. I'm a financial advisor. I believe in the market and I believe in our economy, but it's not something that you play. And when it comes time to shift gears, when it gets close to the time you're going to need to rely on this money that you've spent years and years saving, you can't keep the same investment strategy you've had. Think of it like climbing a mountain. While you're working and accumulating, you're climbing the mountain, you're going up. And as you retire, you start descending. You start coming back down the mountain. Here's the thing. Climbing a mountain is completely different than coming back down a mountain. You need different gear. You need different techniques. You need a completely different mindset. If you don't adjust, coming down the mountain can actually be more dangerous than going up the mountain. You need a different plan for a different phase of life. So please, if you're watching this right now and you don't have a plan and you're close to retirement, find somebody who can help you. I don't even care if it's me. We're staring down the barrel of what looks like some pretty serious market volatility. I don't know if a big drop is coming. I don't know if a recession is coming. I do not have a crystal ball, but I can tell you that we're seeing volatility pick up. We're seeing the stock market falling. And as much as I've talked about this for months on the channel, you have to protect yourself if you're getting close to retirement. So what can you do if this sounds like you and you're watching the video? I'm going to give you a quick overview here if you haven't seen some of the other stuff. And then I'll link a video for you at the end about how to structure your investment portfolio as you get close to and into retirement. The first step is to assess the risk you have and make sure it doesn't have the ability to impact your ability to retire. Your money's there to support your life. It's not there to control your life. It shouldn't be making the decisions for you. So you've got to control it by having a plan. Once you understand the risk you have, the next step is to understand what you'll need from your portfolio in retirement, how much is going to be coming in every month, and how much you need to go out to pay the bills for day-to-day living expenses. So let's use an example. Let's say you got $3,000 a month coming in Social Security and retirement, and you're going to need $6,000 a month in total to pay the bills. Say you got a $3,000 a month income gap. Now let's look at the resources that you have. What have you put away to deal with this gap? Let's assume that you've got $1 million in retirement assets. Now I want you to think about this in 3 buckets. The first bucket is a place for very near-term money. Money you're going to need for income in retirement. The money in bucket 1 has 2 jobs. First off, emergency fund money in case something comes up. And 2, the money you'll need for income every month, that $3,000 a month gap. Now, for somebody with a pretty good sized gap, $3,000 in this case, or fully half of the income you're going to need, we want to keep closer to 3 years worth of income in this bucket. You can go less if you have a smaller gap. Here's our bucket number 1 math. Let's say that you want $30,000 in the emergency fund, and then you need $3,000 a month, and we want 3 years worth of that in that bucket as well. That's $108,000. So we've got $138,000 in your bucket 1 money. Now we're not too worried about this money fluctuating because we're going to put it in things like money markets, savings accounts, maybe some short-term CDs. We've now bought ourselves at least 3 years of protection on our retirement income from market volatility that could happen. Now we'll move on to bucket number 2. These are income producing assets that are designed to have less volatility than pure stock market growth, less fluctuation there. And it's going to be money that can help refill bucket 1 as we draw it down for income purposes. This could be longer term CDs or fixed annuities for somebody with a very low risk tolerance, on up to things like bonds, a bond ladder, dividend paying stocks, something like that for someone willing to accept a little more risk. Between bucket 1 and bucket 2, we want to buy 7 to 10 years worth of income needs, again, based on the risk level somebody's comfortable with. Now, in this case, we had filled bucket number 1 with 3 years worth of money. So we're going to play this conservatively. We're going to fill bucket 2 with 7 more years of money. Remember, $3,000 a month. For 7 years, that's $252,000 is going into bucket number 2. And now we've got 10 years worth of income coverage, not counting the gains and interest that money will earn over time before we have to tap into anything in bucket number 3. Bucket 3 here is going to get the rest of the portfolio, and that is going to be our stock market growth money. That's there to grow for the future, to cover future income needs, to help protect against inflation. And in this case, even in a very conservative example where we really loaded up the first 2 buckets relative to the portfolio, we've still got $640,000 to work for us in the long run. But most importantly, what we've done here is we've protected that money from needing to draw from it. And we've allowed ourselves the ability to draw from it at a time of our choosing, which means all along the way, if there's a large downturn, we've got protection from that downturn from dictating our lifestyle, dictating the retirement that you'll live. Participate in the market, but do it in a smart way as you near or enter retirement. Now, this is a super broad example, and there's way more to it than that. I'll link a video here for a deeper dive on bucket planning, but if you're concerned that you are at risk, if you don't have a plan in place, your retirement might be on the line, check out the link in the description and set up a time for us to talk, and we'll see how we can help you.